So the Fed just told us when quantitative tightening is going to end. Fed Chair Jerome Powell was speaking at NABE, the National Association of Business Economics, where he was receiving the Adam Smith Award. Just something that happens to Fed chairs as they exit. The speech itself was interesting. I'm not going to watch it and play it, except for this clip.
Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months.
So when Powell's talking about the balance sheet, what he's really talking about is this chart. That's the total assets that the Fed has on its balance sheets, or the assets that the Fed owns. And they buy treasuries and agency-backed mortgages from public markets. They do that by printing money and buying those assets and holding them on their balance sheets. And then when they don't need them, they sell them or let them roll off. They let them mature and they destroy the money. So it's all supposed to be kind of a net even. But this balance sheet, this chart, represents how much the Fed has on its assets. And so this is the balance sheet runoff. We're seeing that slope down. That's what Powell's talking about there. That little spike in the chart, by the way, is when Silicon Valley Bank failed in 2023, just as a note. So we've been in a quantitative tightening cycle, and that's coming to an end, but I think it's important to see why we were in a quantitative tightening cycle. So here is the full cycle as it has played out. When we're looking at this chart, what we're looking at is in the beginning of 2020, during the pandemic response, the Fed lowered interest rates to zero. So interest rates is the orange line. The Fed begins to very aggressively inject liquidity into the market. That's that purple line, that total assets. That is the same chart as we looked at in the first one. It triggered inflation, which is that green line. So inflation spikes. This was mostly caused by helicopter money, supply chain issues, this injection of liquidity, ZIRP, zero interest rate policy. So the Fed reacts. They began to raise interest rates in 2022. We see the orange line begin to climb. They began to taper off, curb, and hit a peak on their balance sheets. The purple line peters out, except for the bit in Silicon Valley Bank, and inflation begins to come down as we drain and reduce liquidity out of the market. So the next question is, when will QT end? Well, we probably have about 100 basis points of interest rates to go from here, down to 3% from 4%. This is going to be the October and December Fed futures markets currently. They're expecting a 25 basis point cut at the end of this month in October. And then they're expecting another one at the next meeting. We skip a month in December. So at the December meeting, they're going to cut. At the October meeting, they're going to cut, which leaves us two more cuts going into the new year in 2026. And that will put us very close to where Powell leaves the Fed. That transition is going to be important. So we're setting ourselves up in the next few months to get back to neutral on rate policy. Enter the second part of the equation to end tightening, when we consider the reserves. So here is the New York Fed's attempt at explaining it. I'm just going to read to you what they write as their definition of ample, because it's really more of a framework than a definition, and that may help us understand what the Fed sees as ample or understands to what ample is. We can interpret the notion of ample reserves in terms of the elasticity of the federal Fed funds rate to changes in the supply of reserves. Reserves are ample when the supply of reserves is sufficiently large that the Fed funds rate, the price at which banks are willing to trade reserves with one another, is not materially sensitive to everyday changes in aggregate reserves. In other words, in an ample reserve regime, the Fed funds rate can respond to daily shocks, but the response must be small. Or, to put it differently, the elasticity of the Fed funds rate to reserve shocks must be small, so that active management of the supply of reserves by the Fed is not necessary. Okay, that was a mouthful, but I think we can just quantify it, and the Fed does do this for us already. Here is the New York Fed's ampleness chart. So this is looking at what do they consider to be ample. They've already quantified it for us, and they've given its elasticity measurements there. They take this every day. I'll put a link in the description to where you can see this chart, but this is where the Fed determines what is ample. When this figure hits back up to its 2024 highs, it's about 3.6 trillion in reserves. Now, what I'm talking about is I'm not talking about federal balance sheet reserves. Remember, those are being rolled off right now. But what I'm talking about is bank reserves, this chart. These are total bank reserves at Fed funds facilities, including the repos, which are drained right now. These are the accounts that the Fed will monitor. Once this hits about 3.6 trillion, assuming it hits this in the next couple months and our conditions don't materially change from here, we follow the Fed funds rate path, then we should be on track by February 2026 to be done with tightening. And the one problem that I see is that inflation may continue to rise. Now, depending on how long the government shut down, we may not get our CPI data until next month. If that's the case, then the market, particularly the bond market, may be pricing in data that isn't going to show up or is going to show up to the upside. I want to take a look at this chart. This is the blue line, interest rates as of yesterday, so that's October 15th, and the red line, interest rates in July 15th, so that's 3 months ago. We can see that interest rates all along the curve from the Fed funds rate all the way to the 30-year treasury have all fallen. But on the very bottom, you see inflation. That inflation has gone up. Now, this metric is missing October's inflation measure. But October's inflation, based on the Trueflation Index, should be up. So I don't believe the missing report would matter too much. This yield curve situation is odd to me, and I think it's indicative of something we're calling financial repression. I think that the Treasury and the Fed, especially after Powell leaves and we appoint a new Fed chair, I think they're going to collude to control interest rates. And I think we're already starting to see the effects of some yield curve control. Even Powell is in on yield curve control to some degree. I mean, everyone in banking and the Fed in general want treasuries to have low yields so that the government can pay very low interest rates on its debt and stay afloat longer since they're just addicted to debt. Here's our chart of our debt. So they need low interest rates in order to keep the government functioning. The Fed understands this, even if they don't outright believe in manipulating the market. Powell's response to the question about, should you do yield curve control was, he said that if we achieve the dual mandate, stable prices and maximum employment, then the yield curve will take care of itself. Well, employment is getting worse, and so is inflation. But the yield curve is getting better. Something else is going on. See you next time.